In this week's video, we'll take a detailed look at levels that are key to the stock market making a lasting bottom. If you're a client, especially in this environment, it's important to keep in mind every decision is made taking the entire portfolio into consideration. If we were to say that we have a 30% loss on a trade, we really don't know what that means unless we also know the allocation to that position. So if I lose 30% on a position that makes up 100% of my portfolio, I lose 30% of my portfolio. If I lose 30% on a position that's only 1% of my portfolio, I've only lost 0.3%. In a nutshell, everything is done for a reason, and everything is well thought out, and everything is done taking the entire portfolio into consideration. You might say a loss of this magnitude really doesn't make sense, but with higher volatility positions, some of them just swing, and you have to take that into consideration. If you try to invest in crude oil, and every time it falls 8% you get out, it's going to be very, very difficult to invest in crude oil. Hence, position sizing. We're always trying to balance the desire to get to the other side. How are we going to get back to fully invested over here, taking into consideration that we still might be here? All three of these bullet points are relevant. We're in a rare situation here where most assets are down big, especially looking back 2 years. Formal definition of a recession down here. This week, GDP earlier in the year revised in a downward manner, worse than we thought. Atlanta Fed GDP now, which is watched on Wall Street earlier in the quarter, was projecting GDP growth of over 2% here. They just came out with another huge revision on Thursday of this week, and now they're projecting a loss of -1%. Why is that relevant? Upper right-hand corner of the screen. Now market participants are starting to think that the odds of a recession are getting very, very close to 100%. Net bottom line, things look worse than they did a week ago. So last week, remember, we covered the largest S&P 500 drawdowns going back to 1950. The median declined 16.34%. If we only look at the cases that occurred within close proximity to a recession, these numbers jump, and that's the main takeaway. If we put these drawdowns hypothetically on a 2022 chart, you can see the drawdowns historically, when you go into a recession, they're all over the place. So it doesn't really help us in terms of where the market might bottom. It simply tells us that typically the drawdowns are larger if you go into a recession, this side versus this side. Probably fair to say the odds of a recession have increased this week. This is bad news, and this is bad news. On the other side of the ledger, economic data that came out Friday really doesn't look recessionary at this point. We could spend a whole video showing oversold or bearish or extended sentiment type data readings that we have in the present day. This is another one here. You can pause your video player. Those are setups telling us to keep an open mind about better things happening in the second half of the year. This was the worst first half since 1970, where we lost 21%. What happened in the second half of 1970? Answer, a gain of 26.72%. That doesn't mean we're going up in the second half of the year. It just tells us we have to keep an open mind about a wide range of outcomes. You can pause your video player here. Talked about this last week. The Fed is not in our corner, and they have not pivoted. You can pause your video player again. This could potentially be some good news. Talked about this last week as well, dated June 30th. It's basically saying that the bond market has shifted gears. It's starting to be more concerned about the economy and less concerned about inflation. And obviously, inflation is our number one problem here, telling us we might be getting closer to a Fed pivot. Same article, weakening economic growth has taken over as the biggest concern relative to the markets. This type of expectation, highly volatile, meaning interest rate expectations. Can't look at this in a static manner. From JP Morgan, consumer confidence in the stock market. When confidence is really, really low, like it was here in October of 1990, 12-month S&P 500 return, 29.1%. 22% here, 20% here, 32%, 14%, 22%, 15%, 43%. That's after you hit the trough. This is where we are in the present day. Have to keep an open mind about a wide range of outcomes. This is a setup, and it has not troughed at this point, but it's still very, very relevant in terms of our mindset and flexibility. Pause your video player here. When the S&P has fallen at least 15% in the first 6 months of the year, as it did in 1932, 39, 40, 62, and 70, it has risen an average of 24% in the second half. Doesn't predict anything. Just good to know. Summary slide from last week. All of it still applies, including this, and this. Still seeing this, still seeing this. This is still a factor, and this is still a factor. We've obviously been keeping a close eye on this. No discernible change or improvement. This is being recorded, all of it, 100% of the video during Friday's session. And this figure here speaks to this concept here relative to how much of our cash, what percentage of our cash have we redeployed, and what percentage of our cash is still in cash. We still have a large cash position. These concepts here speak to trying to prudently manage risk and reward in the short to intermediate term. This is the NASDAQ. This is the cluster that we've been talking about. During Friday's session, we're still in this area here. This is possible support. If that doesn't hold, we come down into this area here, the COVID peak here from Thursday's close, a drop of about 11%. There's two ways to look at volume by price over here. We can look at it all the way back, or we can look at it relative to the buying on the way up. These are key areas in here that we're still holding during Friday's session. This was the look here, NASDAQ relative to the S&P 500 in the short term as of Thursday's close. Been oscillating back and forth between leading and lagging during Friday's session. No major change here yet. For clients, we have a spreadsheet, 80 areas of possible support based on the NASDAQ, Dow Jones Composite, Dow Industrials, NASDAQ 100, NYSE Composite, S&P 500, and the equal weight S&P 500. To summarize, if we were to drop roughly 3 to 4% from Thursday's close, that would open the door to a decline, an additional decline from Thursday's close of closer to maybe 9%. You can see the S&P 500 here. Volume by price, we're still holding in this general area during Friday's session. If we zoom in on this area here and this area here, in terms of what investors did in this window, this is the area that's the most relevant in here, that November 2020 cluster. This cluster low here is 15.22% below the close on Thursday of this week. And the COVID peak here, which is also in that general area, so here to here is the most relevant area. That's 10.54% below the close on June 30th. So it's a balance. We're still near an area of potential support on Friday, but we have to understand the potential downside if it doesn't hold. Same concepts here. June 30th, NYSE Composite, no discernible change during Friday's session relative to this area. The difference is the support comes from the COVID peak and the COVID gap area here, and below that would be the November 2020 cluster. So again, if we zoom in, the most relevant area is this area here, volume by price. This is the second most relevant in here. The COVID gap about 6% below Thursday's close. This area in here, this gap where my cursor is, about 14% below June 30. If we look at volume by price, Thursday's session, this is the recent low. We're still holding this low. This is another potential air pocket in the short run. Thus, a basis for patience, potential support, respecting that downside risk or an air pocket could be close by. Same exact concepts, NASDAQ 100. This is basically where we're trading during Friday's session. We're still near an area of potential support. If we zoom in on the similar areas, February 19th high, about 15% below where we were trading on Thursday. So that would be this point here. The COVID gap down right in here, about 20% below. In this case, in the June 2020 low, about 17.54% below where the NASDAQ 100 closed on June 30th. During Friday's session, July 1st, we're trading right around this area here, around 11.5. So this is that November 2020 cluster. This low here, 4.75% below where we closed on Thursday, June 30th. Thus, we're trying to balance the fact that we're near potential support, but if that support doesn't hold, it could open the door to significant additional downside. Similar concepts here, Dow Jones Composite Average. You can see the COVID peak and the cluster, a little bit different area in terms of how they're related to each other. This little area here of potential support, there's a gap in here about 2% below where we closed on Thursday. If that doesn't hold from the zoomed in look, the COVID peak here about 7% below Thursday's close. The COVID gap down in this area here, almost 10% below. And this gap here that was never filled from October, November of 2020, about 12.36% below. The good news, Treasury bonds may be trying to get some type of bid. If you've fallen a long, long way, as IEF has, typically, when the 50-day moving average starts to turn up or flatten out, that's typically a good sign. This is still an extended bearish trend, a trend that has a lot of work to do. So for example, we can run IEF through our scoring system. It only checks 3.04% of the boxes as of Thursday of this week. The good news is we may be taking a baby step closer to a Fed pivot. IEF relative to SPY can check almost 87% of those boxes from the model. And this tells us that the market is concerned, more concerned now potentially, about growth and or a recession relative to inflation. And that's a good thing in the intermediate to long term because it brings us closer potentially to the end of this. But it also tells us the market may have additional downside. At some point, when the market bottoms, SPY should be basing and turning relative to IEF. In terms of an accumulation strategy, this is Thursday's session. This is not what you want to see. Interest rates were down. If market participants felt that we were near the low, you would expect the NASDAQ to outperform. It's not what we had. This also tends to be a concerning look. In a more normal environment or an environment that we're used to, let's say looking back our entire careers where inflation really wasn't a big problem, normally the CCM market model would pivot to Treasury bonds during a bear market in stocks. For example, IEF and TLT both killed it in the dot-com bust bear market and did well during the financial crisis bear market. If we go back to August 6th of 2020, IEF between August 6th of 2020 and June 14th of 2020 lost 18.69%, a significantly different environment. Let's say hypothetically we're heading into a recession and bonds outperform stocks relative to the next leg down in the stock market. When the stock market starts to bottom, we would expect this chart to start to improve in favor of SPY. Just the opposite is happening now. And that tells us to be open to additional drawdowns in the S&P 500. You can pause your video player. This is the same data on a 2020 chart. You can see it comes down the median decline around the same area. This is that cluster we've been talking about. This is the bottom of the cluster here. This is near the COVID gap. And it's near this area here from June of 2020. All areas of possible support. Again, you can pause. The history of bear markets says don't assume any possible support is going to hold. How about that inverse breadth thrust that we covered a few weeks ago? Similar concepts here. The average and median decline would overshoot this area and overshoot this area and come back to the logical area This is logically your best area of potential support. Unfortunately, it comes in around 3,000. Not a forecast. None of this is a forecast. How about the drawdowns relative to the back-to-back-to-back 80% up day that we experienced on Friday, May 27th? You can see we've overshot the typical drawdown. After some of those back-to-back-to-back episodes, you came all the way down here, hypothetically around 3,400, right in this area. In another case, came all the way down here near the COVID high. Similar situation, study that we covered back in May. S&P 500 years where you had a drawdown of 5% or greater at the end of April. The additional drawdown, the average and the median are shown on your screen, and look where they come in. Cluster, COVID peak. A lot of our metrics are oversold, not all of them. You can pause your video player. There's a month-end chart as of the end of June, June 30th. This is the 50-month moving average. Again, you can pause your video player. When the ratio of the 10-year yield relative to the S&P 500 pops above that 50-month moving average, this is 2002, the bear wasn't over. Here, 2008, the bear market wasn't over. Here, 2018, we still had a significant drop ahead. This is what we looked like at month end. Doesn't predict anything. ARKK around noon on Friday. ARKK around noon on Friday, July 1st, has been popping above and below 41. If you're a stock market bear, you'd like to see it give up 41. If you're a bull, you'd really like to see it in this area here. Still a battle. Kind of a mixed bag on these charts. ARKK relative to XLP up 1.63% during Friday's session, again around noon, meaning we're holding this area down here. IEF outperforming SPY during Friday's session around 12:08 p.m. Eastern Time on July 1st. But you can see we still don't have a clear and convincing breakout here. If you're a stock market bear, this is what you want to see. If you're a bull, you want to see something more like this, or even this over here. Haven't dropped in a lot of July 1st charts because there really hasn't been a need to do so. Nothing's really changed dramatically as of noontime. Example, QQQ here. It's down during the session 0.71%, but it's well above this important band of possible support. Doesn't mean it's going to hold, but right now it's holding. Leveraged loans, we talked about it last week. This is an area of potential support. This is an area of potential support. NASDAQ, July 1st, around lunchtime, 12:20 Eastern, still holding above an upward sloping 200 week for now. Covered this last week. Momentum is saying don't assume this is going to hold. Hence why we're watching nearby support so closely. Last Friday over here, this Friday, July 1st, 12:21 Eastern Time, still in that general area and still near all of these areas of possible support. From a broad perspective, you can see how it's possible that the market might start to form a bottom, that we've started a bottoming process. Possible support here about 10% below the June 30 close. Possible support here. These are gaps on the weekly chart. Possible support here about 8% below Thursday's close. And both of those are in close proximity to the 200-week moving average. We still have a lot of headwinds down here, and we're open to accumulating if the data allows. There's a big reason why the word if appears in this last bullet point. Travel and leisure last week. Travel and leisure this Friday, not an encouraging look at the moment. Price is here. You can see we do have a lot of weekly closes in this area, aka potential support. NASDAQ 100 monthly, month end June 30th. The good news is NASDAQ stocks greater than their 200-day moving average, typically we would bottom with this type of look. There's one exception, Q4 of 2008. On September 30th, 2008, this indicator closed at 19. A month later, it closed at 6. During the month of October of 2008, the NASDAQ 100 lost 16.3%. Keep an open mind about a wide range of outcomes despite the fact that we are clearly and unequivocally oversold and in an area where we typically find a bottom, but not always. Last week, similar concepts here this week. We did tick up a little bit here. In terms of the possibility that support that's close by, that it could possibly hold, the VIX has been fairly tame. That can change at any time, but it's still tame as of July 1st, around 12:30 p.m. Credit markets during the session on Friday, July 1st, would have to put this into the highly concerning category. Microsoft weekly as of Thursday's close trading at 256, upward sloping 200 week at 200. Not a good look here. Last week, growth versus the S&P 500, that bounce look. This week, still holding it. We'll learn something either way. Still have a very large cash position. Is it possible we might increase that cash position? Yes, it is possible. You can pause your video player here. Monthly chart. Good things happen here. Good things happen here. Doesn't look good here. Good things happen here. Good things happen here. Breaking down here. It's a weekly chart as of Thursday's close. And this is still a long way away. Defensive staples S&P 500. This is the look. Q4 of 2007. 50-month moving average turning up. This is the look in the present day, month end. 50-month flattening out, price above, making a higher high. Similar concepts here. You can pause your video player. It's made a stand here and here since the low in 2009. This doesn't look particularly good at month end. These signals were nailed down at the end of the quarter and the end of the first half. Thus, we can put this data on a 2020 chart now. Here are the hypothetical drawdowns in those cases here. Average and median case are the dotted lines. You can see they come in near that cluster we've been talking about and in relative close proximity to that COVID peak. Here's an example intraday during Friday's session of what accumulate would look like. The markets are down, but the NASDAQ is outperforming. Why is that relevant? That means that the institutions are positioning for the other side. They think eventually the Fed's going to pivot, and they're starting to change their weightings. If everything is falling in unison, or the NASDAQ is dropping like a stone, or we see something like this, where interest rates are falling as they were on Thursday of this week, and the NASDAQ is underperforming. You can make an argument that's the institution's way of saying we're really not near the low and we're not really positioning yet for the other side. That's one example of accumulate versus cease and desist. Nothing says any of these areas of possible support will hold. It's all possible support. And from a risk-reward perspective, we can make an argument that if your typical position drops about 3.5%, that could potentially open a probability door to much larger declines. As always, the way to handle it is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.